Did you know you are 3 times more likely to become disabled than to die before age 65? A staggering 1 in 4 of today's 20-year-olds will experience a disability lasting at least a year before they reach retirement age. Yet, for most working Americans, disability insurance remains the ignored cornerstone of financial security, often overlooked in favor of life insurance or home insurance. By the end of this video, you'll understand why disability insurance is arguably more critical than life insurance for most working adults, how to navigate its complexities, and precisely what to look for when securing your financial future against the unexpected loss of your income. We'll demystify policy types, key riders, and common pitfalls, equipping you to make informed decisions that protect your most valuable asset, your ability to earn. The biggest financial asset most people possess isn't their home, their 401k, or their Roth IRA. It's their future earning potential. Consider a 30-year-old earning $75,000 annually. Over 35 working years, that's $2.6 million in potential income, not even accounting for raises or inflation. A sudden disability that prevents you from working for years, or even permanently, doesn't just halt your paycheck, it devastates this multi-million-dollar asset, threatening every other financial goal you've set, from paying your mortgage to funding your children's college education or your own retirement. This isn't about medical bills, health insurance handles those. This is about replacing your income when you can no longer work. But here's the crucial distinction many miss: not all disability coverage is created equal. Most people mistakenly believe their employer-provided group long-term disability policy is sufficient. While these plans are a good starting point, they typically replace only 40% to 60% of your base salary, often capping out at a maximum monthly benefit, like $5,000 or $10,000. Critically, these benefits are usually taxable because the premiums are paid by your employer. If you're earning $100,000, a 60% benefit might be $60,000 before taxes, meaning you could be living on closer to $3,000 to $3,500 net per month. Could you maintain your lifestyle on that, especially if you have a mortgage, car payments, and family expenses? This brings us to the most overlooked, yet vital, aspect: individual disability insurance. Purchased on your own with after-tax dollars, the benefits are tax-free, meaning a $5,000 monthly benefit is actually $5,000 in your pocket. Individual policies are also portable, moving with you if you change jobs, unlike group plans. Crucially, they offer superior definitions of disability. The gold standard is own occupation coverage, which pays benefits if you can't perform the duties of your specific job, even if you could perform another job. For example, a surgeon with nerve damage in their hand might not be able to operate their own occupation, but could still teach. And any occupation policy, common in group plans, only pays if you can't perform any job for which you are reasonably qualified by education, training, or experience. This distinction can literally mean the difference between receiving benefits and being denied. Now, let's talk about the cold hard numbers and common misconceptions that cost people dearly. When evaluating an individual policy, several key features are non-negotiable. First, the benefit period: how long benefits will be paid. Options range from 2 years, 5 years, to age 65 or 67. Opting for a benefit that lasts until retirement age offers the most comprehensive protection. Second, the elimination period: this is your waiting period before benefits begin, typically 30, 60, 90, or 180 days. A longer elimination period reduces your premium, but you must ensure your emergency fund can cover your expenses during that time. For a 90-day elimination period, you need at least 3 months of living expenses readily accessible in a high-yield savings account. Beyond these basics, crucial riders enhance protection. A cost of living adjustment (COLA) rider ensures your benefits keep pace with inflation during a long-term disability, preventing your purchasing power from eroding over decades. Imagine receiving a fixed $5,000 monthly benefit for 20 years without inflation adjustments. Its real value would plummet. A future increase option (FIO) or guaranteed insurability option (GIO) allows you to increase your coverage in the future as your income grows, without needing another medical exam. This is incredibly valuable for young professionals whose income is likely to rise significantly. Finally, seek policies that are non-cancelable and guaranteed renewable. Non-cancelable means the insurer cannot cancel your policy or raise your rates, except for age-banded policies, as long as you pay premiums. Guaranteed renewable means they can't cancel it, but they can raise premiums for an entire class of policyholders. Always prioritize non-cancelable for maximum security. The cost of individual disability insurance typically ranges from 1% to 3% of your gross annual income. For that 30-year-old earning $75,000, this could mean $750 to $2,250 per year, or roughly $60 to $190 per month. Factors like your age, health, occupation, a roofer will pay more than an accountant due to higher risk, and chosen policy features all influence the premium. Underwriting for individual disability insurance is thorough, often requiring medical exams, review of your medical records, and financial disclosures. This is why it's critical to apply when you are young and healthy. Waiting until you develop a pre-existing condition, like chronic back pain or diabetes, can make coverage significantly more expensive or even impossible to obtain. Many people make critical mistakes, assuming they're covered. The most common error is relying on Social Security Disability Insurance, SSDI. While SSDI offers a safety net, it has an extremely strict definition of disability. You must be unable to do any substantial gainful activity, and your condition must be expected to last at least a year or result in death. Approval rates are low, and benefits are modest, averaging around $1,500 per month. It's a last resort, not a primary income replacement strategy. Another mistake is believing your emergency fund is sufficient. A typical 3 to 6 month emergency fund can cover short-term issues, but a long-term disability, averaging 2.5 to 5 years, would quickly deplete even a robust savings account, forcing you to liquidate investments or go into debt. But here's the most profound truth about disability that shifts perspective entirely. Disability insurance isn't just about protecting your income, it's about preserving your entire financial plan. Every single component of your financial life, your 401k contributions, your Roth IRA growth, your ability to make mortgage payments, your children's college savings, and your progress towards retirement all depend on your consistent ability to earn an income. Without that bedrock, your emergency fund depletes rapidly, your investments stagnate or are cashed out prematurely, and every long-term goal you've meticulously planned collapses. Disability insurance buys you time, options, and the critical peace of mind to focus on recovery, knowing your financial future isn't spiraling out of control. It's the ultimate protector of your financial autonomy. Now that you understand the critical role of disability insurance, your next step is to explore how to integrate it seamlessly into a holistic financial plan. Watch this video next, where we break down optimizing your emergency fund and investment portfolio for maximum resilience. Because truly robust financial security isn't about avoiding risk, but intelligently preparing for its inevitability.